I'm worried about the potential downfall of the US dollar, its dominant position, and its status as the world's reserve currency. This leads me to question the security of bonds. A friend of mine has invested hundreds of millions in bonds, but I recently opted to purchase more silver and store it in a hidden mountain vault. He, however, remained steadfast in his belief in US Treasury bonds. This situation reminds me of the analogy of an eyedropper and a football stadium, which effectively illustrates the concept of exponential growth. Consider a scenario where a magic eyedropper places a single drop of water on a stadium's pitcher's mound, and this drop doubles in size every minute. The question is, how long would you have if you were handcuffed to the highest seat in the stadium before it's completely submerged? Surprisingly, it would only take 45 minutes, demonstrating the deceptive nature of exponential growth. By minute 40, the stadium is nearly full, and it's almost too late to act. This analogy applies to our financial systems and the status of the US dollar. The real concern is whether we're discussing the dollar as a reserve currency or our basic standard of living. Many parts of the world are already experiencing severe inflation. In the US, we might be oblivious to these global shifts. Like a goldfish unaware of the world beyond its bowl, we fail to see the economic turmoil in countries like Sri Lanka, Brazil, England, and Germany. The goldfish bowl metaphor highlights our short-term memory and limited perspective. I keep thinking about the eyedropper theory and wonder how much time we have left before the metaphorical pitcher's mound is covered, and we, sitting in the top bleacher, are forced to face the consequences. It's crucial to look beyond our immediate surroundings and understand the global context. Collapse in economic systems often starts from the margins, with the weaker players succumbing first, setting off a chain reaction that affects larger, more stable entities. In this context, the United States, with its relative advantages, might not be the first to experience a downfall, but could be among the last. To understand our position in this unfolding narrative, we must look beyond our borders and observe global trends. Countries at the extreme periphery, like Sri Lanka, have already faced severe crises. The scenes of people storming the presidential palace there echo the Arab Spring, where sudden and intense inflation led to widespread hardship and political upheaval. These incidents show what happens when people can no longer feed or warm their families. They have no choice but to overthrow the ruling powers. While Europe hasn't reached such an extreme state, it is moving closer to such a scenario than it was a year ago. The withdrawal from Afghanistan by the Biden administration had immediate geopolitical repercussions. For instance, Saudi Arabia, soon after, began discussions with China and Russia. Recently, Saudi Arabia shifted from the petrodollar to backing its currency with gold through the yuan, a significant move that went largely unnoticed. This realignment, including countries like Russia, China, Brazil, India, and South Africa, reflects a growing desire to trade and invest using alternative systems to the US dollar, seeking more autonomous financial platforms. The invasion of Ukraine by Russia and the subsequent US response, particularly the freezing of Russian assets abroad, has been a wake-up call for many countries. They realize that even if they are currently in the good graces of the US, this might not always be the case. The US's actions in response to the Ukraine conflict, regardless of their justification, have inadvertently encouraged many nations to accelerate their efforts to move away from the US dollar in their transactions and reserves. This shift represents a significant change in the global financial landscape, underscoring the need for countries to diversify their economic dependencies and alliances. This discussion highlights the evolving dynamics of global finance, particularly focusing on the challenges to the US dollar's dominance. Saudi Arabia's recent steps and the collective efforts of the BRICS countries Brazil, Russia, India, China, and South Africa, potentially including Nigeria, to develop a commodity-backed currency, possibly anchored in gold, exemplify this shift. These moves signal a coordinated effort to diminish the dollar's global hegemony. The recent incidents like the Nord Stream pipeline explosion, which remains shrouded in mystery, and the turmoil in the UK political and financial systems, with the rapid change in prime ministership and near collapse of the bond market, underscore the growing volatility in the global economic landscape. These developments, occurring rapidly, align with the concept of exponential growth where changes happen increasingly swiftly, leading to unforeseen and significant events, often termed as black swans. These black swan events, increasing in frequency and impact, raise the likelihood of a systemic breakdown, posing a threat to established financial structures. A key aspect of this shift is the challenge to the US dollar's supremacy, which was established post-World War II with the Bretton Woods Agreement and was further entrenched when President Nixon decoupled the dollar from the gold standard in 1971, transitioning the US from a capitalist to a credit-based economy. The focus on bonds in this context is particularly noteworthy. Bonds represent debt, and there's a growing concern about their stability and value in an economy reliant on credit. The 2019 repo market crisis, reminiscent of the 2008 financial crisis, raises questions about the real value of assets considered secure, like bonds. This uncertainty about the reliability of bonds as a safe investment is critical. Given the current economic climate, the conversation then shifts to a nuanced discussion about the nature of bonds. Understanding what bonds are and assessing their viability as an investment requires a balanced view. While bonds might not be a favorable long-term investment in a rapidly changing global financial landscape, they could offer some short-term stability. This assessment underscores the complexity and evolving nature of financial instruments in a global economy facing unprecedented challenges and shifts. Let's delve into the basics of bonds and how they differ from equities, such as stocks. A stock symbolizes a fractional ownership in a company. For instance, owning a share of Apple doesn't mean you own the entire corporation, but it does grant you a tiny portion of its earnings and assets. In contrast, a bond isn't about ownership, it's more like an IOU. When you buy a bond, you're essentially lending money to an entity like a government or a corporation with the expectation of being repaid, plus interest, over time. Bonds are essentially contractual agreements with defined terms. Bonds are often seen as simpler to analyze compared to stocks. With stocks, you need to consider various factors like the company's future earnings potential, competition, market dominance, etc. Bonds, however, are more straightforward. They mainly involve assessing the contract's terms and the issuer's default risk, i.e., their likelihood of fulfilling their repayment obligations. Government bonds, like those issued by the US Treasury, are often deemed the safest. This perception of safety is partly because the US, as a major global player, is relatively stable, and also because the Federal Reserve can print money to ensure repayments, reducing the risk of default. However, this can lead to inflation, slightly devaluing the repayments. On the other end of the spectrum are high-yield or junk bonds, typically issued by companies with weaker financials. These bonds offer higher yields to compensate for the greater risk of default. Bond yields vary based on their perceived risk. Safer bonds typically offer lower yields, while riskier ones offer higher yields. An important concept in the bond market is the yield curve. Normally, long-term bonds offer higher yields than short-term ones, as lending money for longer periods entails more risk. However, an inverted yield curve occurs when short-term bond yields exceed long-term yields. This inversion often signals market concerns about the near-term economic outlook. It suggests that investors expect short-term turbulence but long-term stability. To illustrate, in a typical scenario, a long-term bond might offer a 5% yield, while a short-term bond offers 1%. An inversion happens when this situation flips. The short-term bond yields 5%, and the long-term bond yields 1%. This scenario can be challenging to interpret, as it goes against the usual relationship between bond duration and yield. In simple terms, normally, short-term bonds offer lower interest rates compared to long-term bonds. However, we're currently seeing an inversion, where short-term bonds are yielding higher interest than long-term bonds. This inversion is significant for two reasons. Firstly, an inverted yield curve is a reliable indicator of a looming recession. When this inversion occurs, as it is happening now, It suggests that an economic downturn might be on the horizon. Secondly, we're facing a global inflation issue, particularly in the U.S., prompting central banks, including the Federal Reserve, to increase interest rates to manage inflation. Our economy has become highly accustomed, some might argue overly reliant, on extremely low interest rates maintained for a long time. As these rates start climbing rapidly, it's a drastic shift. Think of it like this: if you had to drink a gallon of water over a week, it's manageable. But if you're forced to drink it all at once, it can be overwhelming. Similarly, the economy is struggling to adapt to these rapidly rising interest rates. As interest rates were low, people were encouraged to borrow more, leading to an increase in debt. But as interest rates rise, the cost of servicing this debt becomes a significant burden. This impacts taxpayers, as they are ultimately responsible for paying off national debt. The situation is reminiscent of 2008, when low interest rates were used to bail out banks, putting the average taxpayer at a disadvantage. Now, with interest rates increasing, gold and silver prices tend to fall since people prefer the higher returns from other investments. This dynamic affects the entire global economy. For the average person trying to manage their finances, like making $1,000, spending $800, and saving $200, the question becomes where to invest that remaining $200. In the past, options like U.S. savings bonds were considered, but they might not be as appealing due to their modest returns, like buying a bond for $18.75 and only getting $25 after 10 years, as was the case in your childhood experience. This leaves people looking for where best to allocate their savings, considering current economic conditions and investment options. My wealthy mentor highlighted how inflation can significantly impact finances. By the time I was 10, I was already grappling with these concepts. If you had $1,000, deciding where to invest, it can be challenging. Do you trust it with the government in bonds, opt for corporate or private bonds, or explore other types like municipal bonds? This topic came up during a discussion with my best friend, who recently sold his business for $2 billion and is heavily invested in bonds. However, I wondered, what if the value of the dollar declines? This is a particularly pressing concern in countries like Japan, where the economic timeline for action might be shorter than in the US. An unconventional yet seemingly safe investment today could be something as simple as a can of tuna. I found one for just 20 cents. It carries no counterparty risk if a grocery store like Safeway or Albertsons fails. I still have the tuna, but if I owned stock in these companies and they collapsed, I'd lose my investment. In a way, tangible assets like tuna offer a hedge against currency devaluation and inflation. Investing in hard assets, especially those generating income that can potentially adjust with inflation, seems prudent. This could include real estate or commodity producers. While it may sound trivial, stocking up on items like cans of tuna is a reasonable strategy considering the direction of food prices. Additionally, it's important to understand the critical role of energy in the economy. No economic activity is possible without energy. The price of goods is heavily influenced by energy input costs. For example, catching tuna involves more energy than one might assume. It's not just about the fish in the ocean, there's the manufacturing of boats, fueling them with diesel, and often transporting the catch to countries like China for processing before it returns to American shelves. The amount of energy embedded in every product is substantial. Given the recent upheavals in global supply chains and events like the war in Ukraine, energy costs have skyrocketed. It's vital to consider how vulnerable your investments and expenses are to these escalating energy prices.